recap of last week's call. But you do have that video. If you check your YouTube playlist, Ty, you check your YouTube playlist, you'll see it in there. You guys have access to that. So if you haven't seen the first one, it works with this one. Make sure you go back and watch it. And I think I'm going to go ahead and get started. We have quite a few. People jumped on here, so I'm going to get started. So looks like more people are coming in still. That's good. Good. Okay, so if you guys are just jumping in, I haven't started yet. I'm getting ready to start right now. But we've got a lot of cool stuff to cover today. I'm gonna mute everybody right now. If you guys have a question, unmute yourself. But I'm gonna go ahead and mute everybody so that there's no background noise. So let's see, mute all. Okay. So you guys can unmute if you have a question. But we're gonna get started here. So again, this is the second half of finding out about bank financing, learning about bank financing and unsecured business lines of credit. So let's jump in. So first of all, real quick recap from last week. So this is some of my favorite stuff. So I've gotten over, I think I've done over 2,000 bank loans. So I know this stuff inside and out, and there's a lot to it. In fact, it's pretty cool. I'm doing this. So there's this local charity. This is kind of a secret. I'll let you guys know, but there's a local charity in the Quad Cities, and I'm going to work with their charity to teach a bunch of underprivileged, basically families that are really poor, that have never had good education. I donate a lot of money to this organization, and it's like my favorite one. I really stopped donating to almost everything else, just a couple other ones I do. But this particular organization, we're trying to buy houses, rehab houses, and allow some of these families to take ownership of these houses. So the cool part is I'm creating a little credit course for these families, because people don't know how to qualify for a bank loan. And the whole goal is to, take some of the renters, imagine this logic, take some of my renters and have them stop renting from me and teach them how to be able to buy their own home. So, and then they're basically, I'm not giving them the house. I'm just basically paying for, so what we'll do is I'm donating the money for buying the house and rehabbing the house, but this charity is going to do the work on the house. They've got a bunch of construction crews, so I'm just paying for the materials and the purchase price. And we're not going to do big volume on this. It's just impossible to do big volume with this, especially since I'm funding the whole thing. But we'll do one house at a time, and we'll basically help teach these families how to get, improve their credit score and be able to take home ownership. So it's kind of neat, because I just sat in a meeting yesterday. I'm going to build a whole credit course and probably do some training myself live in this organization for some of these families. So it's pretty cool. So anyway, let's go through a quick review. So last week we discussed, what bankers like to see. First of all, there's three main things that bankers look at when it comes to your big financial picture. And credit score is one of them, but I don't want to talk about credit yet. We'll get to that in a minute. So there's three things to think about. There's net worth, there's liquidity, and there's income. Okay. So those are the three most important pieces to what a banker looks at. Now, if you ranked those, most people would say that net worth is the most important thing, because that's everything you always hear about. Everybody, if you always hear a celebrity thing on the news, they're talking about the net worth of that celebrity. And I'm just telling you guys right now, bankers do not care about net worth. Now, 1 out of 10 bankers will say net worth is the most important thing, but maybe it's 1 out of 20. But most of the bankers like income, one, that's important, and liquidity. So you can toggle back and forth. Maybe about 50% or so of bankers consider income to be more important than liquidity, and the other 50% will say liquidity is more important than income. And the thought process behind that is, if you've got strong income, then you can overcome, issues that pop up. However, if you've got really strong liquidity, that's just liquid cash in the form of cash in the bank. It could be in the form of stocks. It could be, a life insurance policy. It could be anything that you can access quickly as cash. Now, if you get into a cash crunch or you get into a bad situation, if you've got strong liquidity, you can draw from that liquidity and fix problems. Remember, banks are always thinking the worst. They're thinking, what happens if this? What happens if that? Okay, he's got good income. That should overcome a lot of things, or he's got a lot of liquidity. Now, net worth, the reason why that's not important or as important to a lot of bankers is because with net worth, it's only, first of all, most net worths are not calculated correctly. And mainly because if I own a house and that house is worth $100,000 and I owe $80,000 on it, is my net worth on that house $20,000? Most people would say yes. Simple math, Matt. You've got $100,000 minus the $80,000 mortgage. You got $20,000 net worth. Well, technically that might be accurate, but in a situation where I need to access that equity, if I'm in a hurry, am I going to sell that property and capture $20,000 in equity? And the answer is no. The answer is, well, I might have to pay a real estate agent to sell that house. That could be 6%. Well, now I'm down to 14% or 14,000. What if I don't get full asking price? What about closing costs? So that's why I don't value net worth as important as liquidity and income. And most bankers don't either. Now, here's a cool part. Maybe you have a whole bunch of rentals and the income's really strong. Well, then that's important because those rental properties are drawing income. So that's how it outweighs maybe the actual net worth piece. So again, I like to say, income, liquidity, net worth, if you focus on that order, then you'll usually be in pretty good shape. The other cool thing is if you got strong income, it builds your liquidity. Because if you're taking that income and you don't have, you don't burn all of it every single month and don't spend a bunch of money, then you can build up your liquidity through that strong income. So anyway, that was a quick recap of some of the stuff we talked about last week. So let's jump into, I want to cover stuff about credit score real quick here. First of all, let's talk about bankers do look at credit score. Okay. When you're getting an unsecured line of credit, if you're getting a bank loan, a lot of bankers will look at your credit score. Now, I will tell you, the larger your net worth, going back to this net worth number, the larger your net worth or the larger your financial strength is, the least they'll look at your credit score less and less. I know plenty of people that have $40 million, $50 million net worths, and some of that might be 20 million liquid, that have 600 credit scores. They don't pay attention to their credit. They don't use a lot of credit. When they get a loan, like on a piece of property, it's not personally guaranteed. So it's not building their credit. It's a commercial loan. It doesn't even go against their credit score. So a lot of those people they don't have good credit score. But I can tell you that if your financial picture is strong enough, the credit score means less and less. And I'll just tell you guys, my personal opinion on credit score is it's kind of a joke. I had at 30 years old, the first time I ever had my credit run that I knew, I had my credit run in the past because my dad had taught me how to get loans before I needed the money to build my credit, because my dad always said things like, hey, make sure you have strong credit because you'll never have the cash to buy anything. You need credit to buy a car, you need credit to buy a house. So he taught me how to get loans at a very young age. And so but I didn't have any idea what that really meant until I went to buy my very first investment property. And again, I bought my investment property at a time I was renting. So I had never bought a house before. So I just remember and I think I told this story last week, when I got my credit score run the first time, I had an 822 credit score. Now that's really high. 850 is perfect. So I can tell you this, at 30 years old, I don't have an 822 credit score right now. So at 30 years old, I had an 822 credit score. I can tell you this, I had zero financial strength at 30 years old. I had $20,000 plus in credit card debt. I had very low income. I had a negative net worth, but my credit score said 822. So I could get loans. And so, just to tell you how much of a joke that is now, I don't know what my credit score is right this minute because I've paid less and less attention to it over the years, but it fluctuates up and down depending on what's going on. And but I can tell you right now that my credit score could be 100 points less than an 822 right now, and I'm a million times more financially strong than I was at 30. But if you just looked at my credit score, you might say no. So that's why I don't really like credit score. Unfortunately, the banks do, and a lot of people do. So you've got to focus on making sure it's strong. Now, I can't remember the last time. I don't know if it's ever happened that I got turned down for a loan because of a credit score. My credit's always been really good. So, but I know other people. I know somebody in particular right now at the top of my mind that had a $20 million net worth, had millions of dollars in income a year, had millions of dollars in the bank. I think at this time he had 8 million liquid. He got turned down for a loan because his credit score was too low because somebody on his team forgot to pay a water bill. And he told me the story. And so it hit his credit and he didn't get a loan. I just thought that was crazy. Now that was one particular bank. I don't think that would happen in most banks when you have that much liquidity and income, but it happened to him. So let's talk about how to build your credit. First of all, there's a few factors that go into building your credit. One is your payment history. Okay, a perfect credit score is 850 in most FICO credit score reports, and which is what most banks use. So your payment history is the most important piece, and that counts for 35% of your score. So if you've got a good payment history, 35% of your score is just based on that. So don't miss payments. Set everything up on auto pay. If you're short, I'm going to teach you some tricks, maybe that if you're short on cash, some things that you can do to make sure you never miss a payment. But don't miss payments. Set everything on auto pay. Live within your means. Make sure that you're not overextending yourself. Just do not allow any payments to get missed. Auto pay saves everything. So make sure that's happening. So again, 35%. Nothing on your credit score matters more than on-time payments. Okay. Second thing is your credit card use. So a lot of your credit score is based on credit card use. Let me give you an example. If you've got 5 credit cards, and each credit card has a $10,000 limit on it, that means you have $50,000 in credit access to credit, 50 grand. Now, if you've got $50,000 and you use $50,000, that means your credit use or your credit utilization will be 100%. That's bad. Now so payment history is 35%. Your credit usage, your credit card usage is 35 or 30%. So the on-time payments 35, credit card usage is 30. So it's the second most important piece. So the key is whatever your utilization, whatever your amount of credit you have is, you want to keep that at 30% or less, and ideally at under 10%. So if you've got 50,000, if you've got 5 credit cards and each credit card has a $10,000 limit and you have $50,000 of access to that cash on your credit cards or that credit, you don't want to use ideally less than 5,000. Worst case, 15,000. Now, some of you guys might be saying, but Matt, that just doesn't make sense. I use my credit cards all the time. Like, how would I get around that? Well, let me just tell you, there's several ways that you can trick the system. One is pay off your credit card every single day. Now, that may not be possible for you. Maybe your business uses money and you need it for the whole 30 days. But if you get online and you pay off your credit card every single day, you have access to all that credit, but you're not using any of the utilization. Now, what if you don't have the ability to do that? Don't worry, there's ways to trick the system. Here's one. Go get more credit. Okay. So let's say let's say, and there's a couple questions, and I'll jump to that in a second, you guys. Let's say you got, let's say that you have, there's two things you could do. If you pay them off every day, that will make it so you're not using any utilization. Second thing is you can find your day that payment, you can figure out the day that your credit gets pulled, or that statement comes due. And if you pay it off before that statement comes due, then you would also show a zero utilization. So for example, let's say on the 10th of the month, your credit card statement comes due, and you pay off your credit card in full by say the 5th or the 6th of the month, gives the bank a couple of days to make sure they process the payment. And then by the time that your credit card company produces the bill on what you owe, it's already paid. So that would show you zero utilization. So that's the other trick. If you don't, if you want to get around that. Second, the next thing is you can add more credit cards. You can literally call and find more credit cards that you could apply for and get accepted, and grow the number, the amount that you have available. So in the situation, let's say you have 5 credit cards that each have 10,000, and you're using 40,000 of that. Well, now you're at a very high, you're at 80% of the usage of your credit cards, and now your credit score is going to take a big hit because of that. So if you went out and said, hey, I'm going to add 10 more credit cards or 5 more credit cards, and I'm going to try to, raise my limit on the overall picture and add another $50,000 in available credit, then all of a sudden now you have $100,000 in available credit, and your usage goes way, way down based on the amount that you have available, being that you don't go run those credit cards up as well. So always apply for more credit than what you need by far. The other trick is, if you're going to do that trick and apply for more credit cards, apply for them all on the same day. So go in there, figure out which cards you think you could get the best, the highest amount from, and ask for a high amount, and go after them all on the same day. So your credit, sometimes that takes a couple of days for the credit bureaus to see that you've been applying for credit. So you want to do it all on the same day. Now, you will have another thing, when you do that, you're going to have a couple of things that happen to your credit, and we're going to talk about that in a minute, but you're going to see how much of a low impact it is. So again, payment history, 35%, credit utilization, 30%. Very, very important there. The next thing is your credit age. Now, what that means is if you have and I know, Tyler, you're jumping on and answering some of these questions, evidently. Yeah. Tyler was a test study for me, by the way. Tyler, a lot of you guys realize Tyler's from New York. He came to the Quad Cities a couple of years ago. He was 18 years old, had 0 credit. Hope you don't care if I tell him. Okay. But he had 0 credit, and I've been mentoring Tyler. It's kind of cool because he's got his own duplex now. He's got a life insurance cash valid policy. He's got his 401k built. He's got a pretty outstanding financial picture at a very young age, but he listens to everything I tell him to do, and he does it. And so one of the first things I had him start doing was the stuff we're talking about right now. And the last time you checked your credit was like 780, right? Mm-hmm. So Tyler 2 years ago had 0 credit. When he pulled his credit, he had no credit score. He had a 0. He's got a 780 a couple years later, just by doing the stuff I'm telling right now. And he's got a ton of credit cards. He doesn't use them all. He's responsible with it, but he's working the system, what I'm telling you guys to do right now. So I already know this stuff works. I've helped a lot of people with this. So, okay. So credit age. Now, credit age is only a 15% of the overall picture of your credit score. So yes, it's important, but it's not as important as paying on time and credit utilization. So what's credit age mean? That means the age of all your credit. So it could be when you opened a credit card. If you opened a credit card on January 1st, 2020, you don't even have a year utilization. But let's say you got a home mortgage 10 years ago, and that home mortgage is reporting to your personal credit report. Let's say it's the house you live in. Well, that credit will be 10 years old. So let's say if here's another reason why you want to get the credit cards now and never close them. You should never close a credit card, because the longer that credit card stays open, the the better it is for you. The longer it stays open, even if you're not using it, do not close that credit card account. In my opinion, now I had a few closed on accident because I didn't use them for so long, and I never even logged into the system, and they were sending me replacement cards when my other was expired, and I just threw them in a safe somewhere, and I never paid attention, and they automatically closed, and that hurt my credit when that happened. So I remember my average credit went from like 15 or 17 years down to like 5 or 6 years which it hurt my credit score because I wasn't paying attention. I wasn't using the cards, and I wasn't making sure I was updating the credit card companies, and they closed some accounts. The other thing that hurt my credit was when I paid off my house. When I paid off my house, I closed a mortgage. All of a sudden, now that's hurt my credit report. So be aware that I'm not telling you not to pay off your house, but make sure that you're paying attention to that stuff, and that it's something that you're aware of. So again, that's only a 15. Now what they do is they average it. So you might have a home mortgage that's 10 years. You might have a credit card that's 5 years. You have a credit card that's 3 years. You have a credit card that's 6 years. You have a car payment that's 2 years. When you pay all that stuff off, it starts that particular thing back over again. So be aware. Don't close credit cards. It's one of the easiest ways to build credit history. If you don't need them, no big deal. Don't worry about fraud. Credit card, all these credit cards have fraud protection, and I'm going to teach you how to make sure you keep an eye on that stuff so that nothing happens. Okay, so the next thing is, so again, that's only 15%. So how paying on time, 35%. Credit utilization, 30%. And age of accounts, 15%. The next one is 10%. And that is your hard inquiries. So what that means is every time you call a credit card company and ask to get a new credit card, they're going to do a hard pull on your credit. When that happens, that's an inquiry. Inquiries stay on your credit report for 2 years. So, I mean, at one time, I'll just tell you guys, like maybe 3 or 4 years ago, I had 23 in the Quad Cities. I owned 450 houses, and I had, of those 450 houses, I had those loans spread out between 23 different banks. And if you pulled my credit, you would see none of those loans on my credit, because I did them as business loans. They were commercial loans. They were not personal. Even though they were personally guaranteed, they were not reported to my credit. And we talked some about that last week. If you guys don't remember that part, go back and watch. But if you do a loan with a commercial bank, you get the loan in the LLC, and then it's not against your personal credit as long as it's not resold to Fannie Mae or Freddie Mac. If it's held in-house, that should not report to your credit. Okay, so with that is, so a hard inquiry though. So every single one of those banks, even though it didn't report to my personal credit, they still ran my credit every single year in order, as part of a bank policy. They'll pull, if you have a loan with a bank, sometimes they'll just pull your credit every year to see how you're doing. So imagine 23 different banks. Every single year they're pulling my credit, and that stayed on my credit for 2 years. So some of these banks were hitting my credit twice before it fell off. So every single month, anything that's over 2 years ago falls off and becomes, gets taken away as a hard inquiry. But I would have 30, 40 hard inquiries on my credit report. That was one thing that dropped it down. Nothing I could do about that. I still wanted to get the loans. So, well, I guess I should say at that time, nothing I could do about that. But now, knowing what I know now, I would do less loans, or I would do more loans with less banks. So if instead of spreading out 23 different banks for 450 houses, I would try to go after and keep maybe 50 houses per bank and only do, 8 or 9 banks, which is what I do now. So now the number of inquiries is a lot less. I always have less than maybe 15 or 20 now, versus, 40 like a few years ago. So how much does it hurt your credit? Well, it's about 10% of your score, and a hard inquiry will drop your score about 5 points. So, and that's not exact. It could be 3, it could be 6, but it's about 5 points. So if you have a 750 credit score and you decide to call 5 different credit card companies and they pull your credit, those 5 will probably drop your score about 25 points. So you'd be at 725. But those will fall off in 2 years, and every month that becomes less of an impact and your score will go back up. I think after 3 months, it basically almost kind of zeroes out as long as you didn't do anything else. So the last thing is that you want to watch for is just the total mix of the type of accounts that you have credit with. It also, that only impacts about 10%. So for example, good credit is a car payment. Good credit is a house payment, a house mortgage. Good credit is a credit card from American Express, Discover, Visa, MasterCard. Bad credit is getting a credit card from JCPenney or Costco or, anything that's a store, a merchant store. You do not want those credit cards. You only want the major ones: Visa, MasterCard, American Express, Discover. Don't get any other credit cards, because that's the type of mix that helps your credit. Again, it's a small impact. It's only about 10%, but all this stuff adds up, you guys. And if you want to get, a really good credit score, then all of these things will add up, and 5 or 10 points here and there adds up to maybe getting you up to a 780. That's the magic number, by the way. If you get a 780 credit score or higher, you basically will never get turned down for credit, outside of, maybe a mortgage or something that might, the bank might look differently at. So kind of those are the factors that if you add it up, so you got 35 plus 30, that's 65, plus 15 is 80, plus 2 10s is 100%. That's what makes up your credit report. If you really do well at those things, then you will have a good credit score. Now, some of the myths out there were, if I get a loan and I pay it off, that makes my credit look good. No, it actually doesn't. The fact that you have 100, you had good payment history, that's good, but you closed the account, even though you paid in full, now your credit ages down, and that will affect your credit. So anyway, I wanted to, that's the basic ways to keep your credit really high. You do those things and you will, your credit will climb. Again, I just using Tyler as an example, he went from a 0 credit to a 780 in a couple years. Super simple stuff. So the biggest things, again, that I would say is make sure you pay on time and open more credit cards and have a bigger credit limit that you need. One other thing you can do is, after you've had a credit card for 6 months, call them up and ask for more. So if you've got a credit card with a $25,000 limit, 6 months later, pay on time. Then in 6 months, ask for it to go to $50,000. I've done that for all my credit cards for years, and I've built massive amounts of credit limit on my credit cards, and I don't need it if I don't want it. Unless I'm out somewhere and decide to go out and spend $50,000 on a new Rolex, which I don't recommend that you guys do. Okay. So let's talk. My next note is I want to talk about business credit cards. So here's the other trick. Okay. So a lot of people don't know this. Let's say you all have businesses. You should all have an LLC, and that LLC, again, if you remember from our conversation last week, that LLC should not have real estate in the name. Okay, maybe if you're just using it, I wouldn't even do that for your real estate properties. Like, for example, in the beginning, one of the first companies I had the word holdings in it. You don't want that. You don't want real estate in it. You don't want anything financial. You don't want like capital in the name or financial in the name. And that might not make a lot of sense to you, but I'm just telling you, a lot of credit card companies got wiped out in 2008, and most of it was from the real estate industry. And because of that, there's little in the credit card company's algorithm, when they punch in your name to approve you for a card, there's like 15 or 20 terms they check against. If your company name, this is for a business credit card, this isn't for personal. If their company name has anything that resembles real estate, a lot of times you will automatically get denied and you will start over. So here's what I like to tell everybody. Almost everybody that has a real estate company has some kind of construction in it, right? You're doing construction on your houses if you're doing any fix and flips. If you're just wholesaling, you can have your business do marketing, okay? You need marketing, so you can have a marketing company. This is a great way to build amazing business credit and not have it talk about real estate. So have construction, start an LLC with a construction company name and run expenses through that. Especially if you're rehabbing the house, you should have that separated anyway, just for liability. But then construction companies, banks love lending money to construction companies. So if you have a business entity, again, keep real estate, keep financial, keep capital, keep all those holdings, all those terms out of the name. Watch if you do have it and you've been turned down for business credit card before. Now you know why. But now have that name. So have a different name, so a construction company, marketing company, whatever. And here's the trick. When you go to get a business credit card with that company name and you get approved, guess what? The business credit card company doesn't report to your personal credit unless you're Capital One. That's the only one I've seen that's done it. Now, I personally love the Capital One Spark business card. I have a couple of them in my company. I love them because you can get massive amounts of credit, and they have a 2% cash back, which is huge if you're using your credit cards. For me, we use them a ton for my warehouse when we're buying materials, and that gives us cash back for that card. So I don't know any card that gives better. So I take the risk of having that card report to my personal credit. But the credit line is massive, and we pay it off every day so that I get those rewards. 2%'s a ton when you spend millions of dollars a year on materials. But what I would recommend for you guys, if you don't want to go that route, you could open a Chase business card. You could open an Amex business card. You could, there's a few other out there, but like, for example, Amex, if you started a business credit card with Amex, now let's say you have some personal cards with a revolving debt on it. You haven't been able to pay them off yet, but it's reporting negatively to your credit because that's hurting your credit utilization. You could start a business credit card through Amex that doesn't report to your credit and then balance transfer that amount. But remember, only do that if you can pay it off. Now, Amex makes you pay it off every single month unless you have the Plum card, which is a purple one. You get 60 days for that. It's kind of a little a little trick that most people don't know. So that buys you time. Now, if you don't want to use Amex, go with Chase. And Chase you're not required to pay it off every month. So that's a cool way to take that credit off your personal score and hurt your utilization. It'll help your utilization. It almost disappears from your credit report. And now your credit will jump and you have more time to pay that off. But again, Capital One, which I love, I have my own Capital One rep. I do such a high amount of spend that they assign me my own rep in the state of Iowa that I can call or text anytime. I don't have to call the credit card company. I call him direct. And I learn a lot of these cool tricks because I ask him, hey, let's go get some lunch. And I got some questions for you on how to work the system. And he tells me. So it's pretty cool. Just remember those things. You can start a business card. It doesn't report to your credit. You can sometimes get huge credit lines. For example, Amex Platinum, that Platinum card, now there's a $500 a year fee with that, but a lot of times it's an unlimited spend. You don't have any limit. So it's kind of nice. If you got a big purchase or a big rehab, you can use that in that case. But yes, but you've got to pay it off. That's the thing is you got to you only get 30 days. Okay, so with that, let me just check my notes here. Okay, let's take a minute. I've been talking for 35 minutes straight. Let's take a minute and ask questions? I haven't been reading the chat because I've been too busy focusing on anything else. Does anybody have a question on anything that I've talked about? Hit your unmute, let me know, and we'll talk through it quick before we move on. Anyone? No questions? That seems impossible. Or is I just did that good of a job explaining everything? You guys all good? David, Bader, you got anything?
I had a quick question. So the first question I typed in the chat was that I was talking to my LLC company that makes my LLCs and stuff. And they were specifically saying that each individual card I have has to be over 0% and under 30%. That you don't want any cards with a zero balance on them.
You don't want any cards with a zero balance?
Yeah.
And why did they say that?
That's how they said to do the utilization, is you have to be under 30% utilization on all your cards.
Yeah. Well,
you don't want to be zero on any of them.
You definitely want to be under 30%. That's for sure. But to be over zero, I don't really understand that logic.
So they specifically said don't have like 20 cards, but max out one of them. Even if you have 20 cards and you max out one, that's still triggering. They said that's triggering the hit to the credit score.
It's not. Mainly I know that because one of the things that everybody here needs to do is go start a Credit Karma. It's a free account. You can check your credit. It's not a hard inquiry. It's a soft inquiry. When you check your own credit, it doesn't count as an inquiry against you. But if you look at a lot of times, I do a couple different ones. I do Credit Karma and I do Experian. And I do their paid service because I try to monitor my stuff fairly closely, mainly because you get an alert every time somebody pulls your credit. But I remember looking at those reports and it just balls them up into one big utilization piece. So it just says, hey, you've got $500,000 in available credit. You've only used 10,000. Your utilization is less than 1%. You're amazing. So I don't agree with what they're saying on one card, because I typically have, and I know Tyler does this too, but I typically only have one or two cards that I use, and I don't use the rest, and they sit on the side. And when my utilization's really low, my credit score is high. So,
Got it. Okay.
Anybody else? All good. And I know there were a few questions in the chat. Tyler, I think you're getting to some of those.
Yeah, we answered a lot of them.
Okay. Okay. So let's keep going. If there's no other questions, for now, I'm gonna.
I was just wondering one thing. What are examples of when you would be using credit, like other than like rental properties? Like, is it just rehabs you would use it, or what are the best uses for like having access to this capital?
Well, I mean, let's say you're doing marketing for your wholesaling. You typically pay for that with a credit card. Let's say you're doing rehab on a fix and flip or a rental property, and you're paying for those materials with a credit card, and you're going to pay it off when you sell the house or refinance the house. So that'd be another reason. It's just hard to say. Like, that's pretty much the majority of it. But more than anything, it's not about using the credit cards. It's about your credit score. So if you say, well, I just do marketing on my wholesale business, I don't need a lot of credit. I have a credit card with a $5,000 balance or a $5,000 credit maximum on it, and I only use $4,000 a month in marketing. Well, you're going to show an 80% utilization rate, and it's going to hurt your credit, versus if you had a whole bunch of credit available and you were using 4,000, and if you had 100,000 available and you're only using 4,000 of it, well, now your utilization is only 4%, which is really good. So the biggest thing is here's another good point about your question is, always build your credit when you don't need it. Okay. You never know what could come down the pipeline. I've heard a lot of stories. Now, I'm not telling you guys to do this, but I'm not going to say I didn't do it 10, 12, 14, 15 years ago. I would use credit cards to help me pay for houses. You used to get, I don't know if this is the case anymore because I do everything electronically. I don't know if they still do this, but you used to be able to get these little checks that came with your credit card, and you could write a check in and deposit it into your own bank account, and it pulls from the credit card company and puts that cash in your bank account. Now you can use that to go buy a house with cash. I'm not telling you to do that. I'm just telling you I've done it. I know other people that have done it. You're paying high interest a lot of times, 8, 10, 12% interest. Which is another point I wanted to make real quick. If you're paying 15, 18, 20% interest on your credit card, and you have a balance on there, call your credit card company and tell them to lower your interest rate. It's simply one phone call. Just call them and say, hey, I'm paying too much on interest. I found another card I could transfer it to. I'd like to stay with you guys, but I'm not going to pay 20%. You need to get, what can you get me to? I think we could do 8.99. Boom. And you just cut your payment in half right there. So make sure it's just one phone call. It's super simple and something anybody can do. So any other questions real quick before we move on?
Yeah, what's your ideal loan to value? Like, speaking of debt that you keep on properties, like what's your ideal loan to value ratio before you like refinance and pull cash out?
Well, typically most banks will do between 75 and 80% of whatever it appraises at. As long as you interview the right banks. So I would say that's ideal. You don't want to, here's the thing is you need leverage more when you first start versus once you've been in it for a while. Because if you've done it right, hopefully you've built your net worth, you've built your liquidity, and you want more cash flow. And the lower the rent, the lower the loan amount you have on your house, the more cash flow you're going to get. So I would say, try to stay around that 75 to 80% number and try not to go much over that, because then you're going to really be squeezing out your cash flow. You know what I mean?
So even as you're like paying off your rentals, the tenants are paying down the equity, like do you refinance to bring it back up to the 75, 80%, or do you just keep paying it off? Like
depends on if you need the cash for expansion.
Okay.
If you have, let's say you're just like, I'm happy with, everything that's going right now. I don't really need the cash. I'm just going to keep paying them down. But if you're expanding and you're trying to grow and add more properties and you're getting amazing deals, there'd be no reason not to do it that way. I've done it. I've done that in the past where we aggressively paid down for a while, and then all of a sudden I needed cash. I owned the properties 4 or 5 years. I paid it down. On a 20-year amortization, you're paying almost 3% off on that house per year. So if 4 or 5 years goes by, you've made a pretty good dent. You can turn around and refinance and pull out some cash tax free and go use that cash to go buy a fix and flip or do another rental property or something like that. Does that make sense?
Yeah, that's helpful. Thank you.
Yep. Any other questions before we move on? You guys, is this helpful, you guys? Is this good? Good stuff? Okay, good. Okay, so let's talk about real quick. So I said, make sure you get a Credit Karma account. It's free. What happens is if you have a Karma account, you can check your credit and see where it needs help. They have a lot of cool tools to see. You can kind of see, what, if something's hurting your account or your credit score, they'll tell you. I mean, I just ran it out for you so you kind of know, but it's kind of nice that way. Secondly, I discovered like one time, like 3-4 years ago, I checked my credit and took a hit. It dropped down to like a 550 or 600. And I was like, what in the heck? And I went on to Credit Karma, and somebody had taken my social security number and took a loan out in like South Carolina at a bank I'd never heard of, and literally compromised my social security number. And so, but they alerted me that my credit score just took a hit. So that I looked into it, and sure enough, I called the bank and said, hey, this guy's not me. And they easily verified that was the case. They wiped it out. I paid nothing. Whoever it was must have got away with it scot-free. But they wiped it out, wiped it off my credit, and my credit score went back up. So it's kind of nice. Had I not done that, I would have gotten surprised when I was filling out a loan application with a bank, maybe to get a property. So secondly is every time, here's the cool, this is the thing I love about Credit Karma. Every time a bank pulls your credit, you get an alert. So every time your credits run, boom, you get an alert. You can go see who in the heck just pulled my credit. Because sometimes it's happening because you might be asking for a new credit card. Other times, just an annual report, some bank's just pulling your credit. And so sometimes you can dispute that and say, hey, I never gave you permission to run my credit. You just hurt my credit score by 5 points. I want you to wipe that out. Sometimes they will. So that's why I like the Credit Karma, because they keep an eye on your credit. Okay, so if you do have if you have a dispute, this is really powerful. This is something you must write down. If you do have a dispute on your credit report, and you call the bank or the credit card company, and they just are fighting you, and they're not fixing the problem, go to CFPB. If you Google CFPB, that's as in cat, F as in Frank, P as in Paul, B as in boy. If you Google that name, it stands for financial protection, like a consumer financial protection business or something like that, bureau or something. What happens is you can go to that website and file a dispute against that credit card company or that bank, and they will wipe it out. They'll take it off your report. If it's legit, they will remove it themselves if the credit card company doesn't. I've had to do that in the past. I had a bank put something on my credit report that wasn't mine, and I called them, and they're like, yeah, we'll get around to it when we do. It takes like 90 days. I'm like, no, you're not leaving that on my credit report for 90 days. I filed a dispute, and it was gone really fast. So make sure you use that to your advantage. If you see something on your credit report, don't just always pay it off. If it's not legit, it could be $10. Somebody gets a water bill that's $10 and it's not yours and it wasn't your fault. Don't just say, I'll pay it, because that stays on your credit report. Even it doesn't matter the amount. It's still on your credit report. File a dispute if they won't remove it, and it'll get removed, and your credit score will jump back up, and it will look like it never was on there in the first place. If you just pay it, it's still there. The fact that you paid it doesn't make it better. It does help a little bit, but on your payment history, it's still going to hurt. So don't just always just say, hey, the amount's small enough, I'll pay it off. Always dispute. Okay, so next, I wanted to take a few minutes. We got about 10 minutes left here. I want to talk about unsecured business lines of credit. Again, you have these credit card companies. That's an unsecured line of credit, but it's not always easy to access, other than if you buy something. Sometimes you can take a cash withdrawal, but there's big fees. Other times you can, might have that little check thing. I don't know if that still exists, but there's still fees. What you really want is an unsecured business line of credit in your company name. It doesn't report to your credit, in your company name. So I'll give you guys a little tip. You can go to, I've had one with Wells Fargo for probably a decade now. 8 years, I think, is how long I've had it. So you can go to Wells Fargo and Google business line of credit, unsecured business line of credit, and you can fill out a simple form. And a lot of times you can give them a little bit of information, and you can get a business line of credit. And that you can get up to 100,000. And how good, again, does your LLC have real estate in it? Does it say financial? Does it say capital? Does it say holdings? You probably get turned down, maybe. But if it doesn't, and it's a construction company, and it doesn't have anything bad in the history of the company, and if it's brand new, sometimes again, if your LLC is brand new and it's never done any business and never had any credit, it's kind of like your own personal score not having any credit. So I don't know how much you can get. I know you can get up to 100 grand, but give it a shot and see what happens. Now they're going to either use your credit score, and you'll have to personally guarantee the loan. Or if you've had an LLC or a company around for a really long time that's had trade lines with places like, Sherwin-Williams or, Granger, or those types of trade lines, those are good trade lines to get for your business, because they'll report good. When you pay them off, they report to your business line of credit or your business credit, And then that builds your business credit. And then eventually one day you wake up and you don't even have to give them your social security number, and there's no personal guarantee at all. The business has enough credit on its own. It doesn't even need you. So that's a little trick on the business credit, is if you go to some of these trade lines and get a trade line, and basically it's like you call, Sherwin-Williams and say, hey, I want to open an account. I'm going to do some rehab. Here's the account name, and here's my EIN number, not your social security number, your EIN number to the LLC. They'll give you a certain amount. They'll say, okay, we'll give you $2,500 in trade line credit. And then you'll use that. Instead of putting it on your credit card, you use it on your trade line. You get 30 days to pay it. That builds your credit for your business, and then you pay it off with your credit card, which gives you another 30 days. And it helps your credit card as well, as long as you're paying everything off fast. But that builds your business credit. And then if you go to like a Wells Fargo and you want to get an unsecured line of credit, you get it in your company name. And once you get it, you'll get a little credit card, a little debit card, and you can just wire. You can ACH money right into your account. There's no extra fees. There might be an annual fee, but there's no extra fees. And now you can use that to buy houses. You could use it to buy houses for cash. So I like the Wells Fargo one. It's pretty easy to get. And you can also go to US Bank and get something similar from them as well. So I would recommend starting with those, but there's a lot of other credit unions that will do the same exact thing. Last week, I discussed with you guys how to find banks and credit unions, how to go into the yellowpages.com, how to Google bank or credit union and your location, go to the last page, work your way forward, and ask the questions that we wrote down. Credit unions are great for unsecured lines of credit. A lot of times you can only get like maybe 15 or 25,000 at a time. But if you got a few of those, then all of a sudden you wanted to pay cash for a house, depending on where you live and how expensive the houses are, you could combine a few of them together, and in your business name, it's not reporting to your personal credit. You could combine a few together, and then all of a sudden you can pay cash for houses, and you're doing the whole thing, and you're not having to borrow hard money. It's not expensive interest. We're talking 3%, 4%, 5% interest and no points for this stuff, you guys. So this is really powerful stuff that you can use to your advantage to be able to buy houses. And again, you don't have to use it. Like my Wells Fargo, I literally got an email like a week ago, and Wells Fargo, I have a savings account and a checking account and this line of credit, and I haven't used it in so many years. They sent me an email saying, if you don't log into your account and let us know you still exist, we're closing your account. Because there's a thing where if you have bank accounts long enough and you don't do any transactions in them, then they'll close your account and your money will disappear. I've heard horror stories about that. And I had a couple accounts with Wells Fargo I kind of forgot about. And so they threatened me with that. If you don't log in and call us, we're gonna take all your money. So I did it. It was super simple and everything's good. Now I'll probably be good for 5 more years, and then I'll log back in 5 years or something, and we'll get it handled then. But so anyway, that's powerful stuff that you can do. And again, maybe you say, man, I just don't need it. Well, you want to get it when you don't need it. You don't have to use it. If there's a small annual fee, I think Wells Fargo's like, I don't even know, a couple $100 a year or something that automatically comes out or something like that. Super simple. But again, get it when you don't need it, because there might come a day that you do need it, and then you have it. The other thing is, the longer you have it, the more you can come back to them a year from now. Let's say that Wells Fargo, you go on there and you ask for $100,000. They say, no, we'll give you 25. It doesn't mean next year you could ask for, hey, I've done really good with this 25, give me 50, and keep asking it to go up. And the better you do with all this stuff, the more you can grow it. But you can ask local credit unions as well, and they'll do the same thing. So any questions on any of that? Anybody have any questions on that? I know we're running low on time. We've got about 4 minutes. And I just covered a lot of stuff, and my mouth's tired from talking. So
that's a quick question. So
yeah,
where you said like the name having it, like say I have like Dan buys houses and I'm doing like wholesaling and I wanted to set up these lines of credit. Would the name have to match the LLC with like what I'm marketing my business as?
No, you could have the LLC. like let's say Dan Buys Houses is what your marketing message is, and maybe that's your website, but you might call your LLC Dan's Marketing Company LLC.
Okay.
See that?
Wells
Okay.
Fargo temporarily suspended line.
I got a question.
Oh, Tyler just said that Wells Fargo's temporarily suspended line of credit apps
Yeah, because of COVID.
because of COVID. Yeah, but watch for that stuff. It'll come back, you guys. I know a lot of credit card companies and hard money lenders and everybody freaked out during COVID, but all of that stuff's turning around. The stock market's going back up. So I foresee that stuff breaking back open here shortly. Anybody else? Somebody else had a question.
I do. If you have, I got good personal credit, but I don't have much of business credit. What's your favorite way to utilize that, and what's your favorite like business credit card to get starting off just for your LLC?
So what if you have good personal credit, but you don't have good business credit because you haven't used
Don't
it?
have a lot of business credit.
So first of all, in your business, is this David Bader, by the way?
Yeah,
That's who-
yeah.
Okay. Hey, David. So here's what you want to do. So, first of all, you do a lot of construction. You need to open some trade line. Get 3 trade lines. Pick if you buy your paint from Sherwin-Williams, if you get stuff from Granger, if you don't, just open one up and buy a couple things and pay it off. And pick one other local company that you would use that offers trade lines that report to the credit. Like you have to get a trade line that reports to the credit bureau. So you can just simply call them up and ask them, hey, I do a lot of business with you. I buy my flooring from you. Do you have a trade? Do you offer trade lines, and do you report? And if they do, open one up and do that now, because you can build your business credit quickly. But in the meantime, open a business credit card, like I was saying with Chase or Amex or something like that, and just use your personal credit score as the personal guarantee. They'll just run your credit on that. But you can still get the card, and it's based on your credit score, but they won't report to the credit bureau for you on that card. So let's say you've got, Dave's construction company. You open up a personal card or a business card with that name or whatever it is, whatever your company's name is. You open up a business card. They report to to get it approved for the amount you want. They're going to hit your personal credit because that's what's good. But they're not going to report the monthly spend that you're using to your personal credit report. Does that make sense?
Yeah.
So that's how you would utilize your score for now. But in the meantime, be building, get a few trade lines in that LLC name, so they start reporting to the business line, the business credit companies, and then you'll build business credit, and eventually you won't have to use your personal guarantee at all. So,
Gotcha. And there's no way what I have at Menards right now is an older LLC, but I switched like 5 years ago, but I didn't want to give that up because I had such a high credit limit.
mm-hmm.
But I need to is there any way to transfer your stuff over into an LLC? Is there any way to do that into a different LLC, like from one to the other without losing all your credit?
You're saying, do you have that Menards card in an LLC you don't use?
Yeah, but like the business, I had it with a partner, but now it's dissolved. So I'm still just using it and paying on it because I had like a $25,000 credit limit, and they told me if I start a new one, I can only get like 5.
Why don't you just keep using it?
That's what I'm doing, but it's
you can file for a name change and do a DBA in that LLC. So let's say it's called Dave and Dan's Real Estate Company, and Dan's no longer around. You dissolve it. File a DBA and change the name to your new company name that you want it to be called, and maybe that's your LLC. Then you're good to go.
You have to be able to update your information for you.
How do you do that? How do you file a DBA?
Just call your attorney that's closing your deals. I did this. I had an old LLC, and I had a partner with it, and I spent like $1,000 to set it up. We dissolved the partnership, but I still wanted the LLC. It had good credit. So my attorney did a DBA, and we changed the name legally, and I still captured all that credit.
Gotcha. Nice.
By the way, you guys, how amazing was my internet this week? A lot better than last week.
Yeah, much better.
So last week, we figured out what happened. So I love the Ring cameras. I don't know if you guys do Ring cameras, but I had like 5 Ring cameras at my house, and we added 7 new cameras because we had dead spots and I just wanted more cameras. And what happens is the internet, the more cameras you have, it pulls from your internet. So we massively increased the amount of internet speed that we had, and that fixed the problem. So shouldn't have any more issues with that. But if you guys get Ring cameras, remember that it pulls your internet big time. So any other questions, you guys? Is this good stuff?
Is business credit the same as regular credit, like the scores?
No, they do it. It's a whole different system. You can go to, if you Google, so for example, I'm pretty sure Experian helps you with, you can do business credit through Experian if you go through Experian Business, but you can also do Dun & Bradstreet. If you Google Dun & Bradstreet and you put in your LLC name, they'll give you a score of, or they'll tell you how good a credit is in your LLC. Sai, you had a question?
Yeah, and this might be I'm not sure if it's for another topic for another day, but you was mentioning about the amortization rate, like 20 years or so.
Mm-hmm.
Do you give any specific advice about when you get the long-term loans, what kind of amortization rate you try to target, or any goals about, I know you mentioned about how you try to pay off the houses faster, like, any tips about that? Ideally,
you have to kind of go by what the banks will allow. Some banks will not do 30-year amortizations on a rental property. And the reason they don't is they want you to pay it off faster, because the faster you pay it down, the more secure they are. So you have to kind of go by some of their rules, but typically you would want the highest amortization rate they would want to give you. And then you can choose to pay down that more if you want. So let's say you say, hey, I really just want to pay this house off fast. I'm going to get a 10-year amortization. Well, that's great. But what if you have cash flow issues and you need the money and now the payment's really high? The other thing is there's called a DSC, a debt service coverage ratio. And if your debt service coverage ratio is way too low, then the bank won't approve the loan, and your global cash flow will look really poor. So the higher the amortization, the higher your debt service coverage ratio is, and that makes you look stronger financially. So I would always go with a higher amortization, and then choose to pay down more on that if you want to pay it down quicker. Let's say the payment is $250 and you say, hey, I want to throw an extra $50 a month at it. That won't hurt your DSCR, but you're also paying it down quicker. Does that make sense?
Makes a lot of sense. Thank you.
Then if you get tight months where money's tight, then you can just call the bank, say, hey, I don't want to throw that extra $50 towards my principal this month. I need the extra cash. I want to just pay the main one. So main payment. Sound good?
Thank you. Very good.
Any other questions, you guys? Okay, well, hey, you guys will have this replay. We covered a ton of stuff. I've never taught what we just covered. I've never taught to anybody other than personal people. So it's very, very powerful. I hope you guys got a lot out of it. You'll have this recording and you can go back and review. But for now, I think I'm going to log out, and we'll see you guys. So Friday, Lewis, my COO, will be teaching for those of you guys that have the whole thing for all the month. Otherwise, I will see you guys next Wednesday, and we'll talk some more then. So we'll see you guys then.
Thanks, man.
Thanks, Matt.
Thanks, Matt.
Yep.